We're acquiring properties that are between 65 to like 85% occupancy and really finishing a lease up and maybe making some cosmetic changes to the building. Nothing too heavy, just trying to get it to stabilization is our game plan.
Do you guys have any kind of red flags when it comes to geography?
We're flexible. I mean, we own and lend all over the country. My markets choose me more than I choose my markets because
real estate is a very small circle. It's a people-to-people business. A lot of people think you just look at Excel spreadsheets and numbers every single day.
I think a lot of stuff is very selectively marketed, and that's real. Even just to get on the top 5 or top 10 or top 30 list, I mean, it takes a lot of work.
The biggest misconception about in this niche real estate market?
I think the biggest misconception is what I spoke about earlier and why I didn't want to take an interview.
Any office to senior housing conversions like taking shape in the near future?
It's tough.
Welcome to another episode of the Dealmakers Chronicles. Today we have Adam Seidenberg with us. He's a vice president at JDI Realty, where he leads senior housing investments. Welcome, Adam.
Thanks, Farrukh. I'm happy to be here. Hey, Farkhad, nice to see you too.
So one of the very first questions we'd like to ask is, how did you get into real estate, and how did you get specifically into senior housing, which seems like a niche within multifamily space?
Sure. No, definitely a niche. I got into senior housing. My family's been in the business for a while. My parents own and operate a couple hundred apartments in Chicago and in the kind of the West Side area and Bucktown and Westtown and Wicker Park. And the way that started actually was my grandfather came over to the United States when he was really young, and he had a bunch of shoe stores, and he sold all the shoe stores like in the late 90s. And then he bought a ton of real estate in Wicker Park on the west side of Chicago, and that became my parents' business too that they run now today. So growing up from a young age, real estate was kind of always around. I didn't know how or kind of what I wanted to do with it, but it was always present, I would say, as like, hey, this is an option for you. And I did a couple internships in college. I started off as a leasing agent working at just trying to lease apartments on the north side of Chicago one summer. And then I kind of got a little more institutional, worked at a big brokerage house before finding my way into a retail REIT, where I worked for about 2.5 years, and I was doing asset management. It's called Inventress Properties, and it was a great experience for me. Learned a lot about modeling, about finance, about real estate, and maximizing value, right? And really, like the way I think about asset management is how do you maximize value over time? And I was learning a lot of that at Inventress. Inventress was headquartered out in the suburbs. I was in the city. It was a long commute, and it was really just time for me to kind of find my next opportunity. And I was looking around. I'd interviewed at a handful of places, and a recruiter reached out to me and said, "Hey, Adam, you should talk to this person. He works at Anthology Senior Living. I think you get along." I said to the recruiter, I said, "No way. I don't want to do skilled nursing. I don't want to do any of that. It's got a bad reputation. It's not what I'm interested in." He's like, "Just talk to this person, and that's not what they're doing. It's institutional. It's luxury. And I think you guys, it's worth an hour of your time." And I ended up connecting with that person for about an hour on a Wednesday night, and a few months later, he was my boss, and we worked together for 5 years at Anthology. So I wasn't looking for seniors. It just happened to be the right place and the right time. Anthology Senior Living and CA Ventures was, an institutional owner, operator, developer, luxury, private pay, ILA, LMC, stuff all over the country. And through that experience, started off in asset management there, then eventually moving my way into the investment side of things, really just kind of fell in love with the space. I think my issue with retail and the reason why I liked seniors a lot was it was hard for me to connect to the real estate in retail in some aspects. We had these huge shopping centers. We drive up to them and tour them and go to the markets. And look, it was interesting and important, but I didn't necessarily feel that connection, to what I was doing. And when you're doing a senior housing property, I mean, you walk in there and there's residents all over the place, right? You're in assisted living, you're in memory care, there's life. And look, ultimately, the type of senior living that I work in, the space I live in, it's a private pay space. It's for affluent older generation, and it's for people who can afford it. And there's some affordability component to it, but there is, kind of this mission driven aspect of it of, hey, we're providing housing for people who need it. So I kind of fell into it, and, any senior living property is kind of like a combination of it's an hotel, it's an apartment building, it's a restaurant, and it's a hospital. So if you can learn all of those, I was told, hey, learn seniors and you can do anything after that. And what I found is like, I don't like the asset classes that don't have all those combined now. So I've really enjoyed it. It's nuanced. It's fun. It's definitely an operating business as well as real estate. But it's been a good niche to be a part of.
So in these projects, are you acquiring senior living facilities and then you're just changing them or operating, or you sometimes building them up ground up and creating brand new supply?
Yeah. So currently at JDI, we only acquire properties. JDI is an opportunistic, value investor. We rarely do development. And so we're acquiring properties. There's, I would call us a value add investor too. I'd say like light to medium value add. We're acquiring properties that are between 65 to like 85% occupancy, and really finishing a lease up and maybe making some cosmetic changes to the building, nothing too heavy. And, just trying to get it to stabilization, is really our game plan. We're not doing really heavy renovations on the physical side of things. But there also is unique opportunity in seniors today to acquire nice cash flowing performing properties at really large significant at a really significant discount to replacement costs, and also at above market cap rates, just because there isn't a lot of equity in the space right now. And there's some dislocation in the market, and there's a lot of landlords and owners today who, as a result of COVID, have experienced just, some difficulties and challenges in operating. And, the cost of a caregiver has gone up dramatically in the past 5 years. And we're not talking about like a 3% increase year over year. We're talking about, really, 15, 20% annual increases on wages. That plus rising interest rates has just put a lot of owners in a tough spot. And that's allowed an opportunity for, sometimes a lender driven sale, sometimes just, a fund life sale, but just to make it so that an exit needs to happen, even if that's well below the prior basis or prior debt value, the transaction is still going through. So with seniors, JDI is probably buying the nicest property we've ever bought. We've been around for 36 years, and historically we don't necessarily buy Class A buildings, but because of what's going on in the space today, we're able to buy some Class B plus, Class A minus type product.
On this, I see it as a company. I was going through your website. I see that you guys do debt and equity. So, on the equity standpoint, is that more of you guys are general partners, or do you invest with other operators as well?
Yeah, we're typically an LP, so we don't operate anything ourselves. We always partner with an operator. Sometimes that operator is a sponsor and is investing alongside of us. Sometimes it's purely a third party, but typically we're doing traditional JV agreements, 90-10, 80-20 stuff on the equity side. We also have a credit fund. We have a bridge lending fund. It's about $325 million today. We lend at 9, 12, 15, 18 month type terms, and we have no covenants. We can close in really as quick as like 10 business days. I would say our average length of close is 30 days or less, and for that we charge an interest rate around 13%. So we've got a lot of land in there. We've got a lot of groups who kind of get to a closing table and a lender falls out, and JDI can step in 15 days and give them a loan, and we lend up to 50 to 60% of value. And when I say value, I mean true value, not necessarily appraised value. And
so if the value of the property is more than the appraised value, would you lend more off of that value, or would still be off of the appraised value, since the appraised value is the lower one?
Yeah, I mean, I don't see a whole lot of instances where that's the case, to be honest.
Well, not anymore, yeah.
But no, we do value will peg to either purchase price or, we'll underwrite it ourselves and see how we would value it. So usually appraised value is coming in higher, but if it was lower and, values increase, maybe people have entitled the land, maybe they've increased occupancy, increased, NOI, we would definitely give them credit for that.
From the equity standpoint, what returns are you typically looking at? Do you underwrite your deals based on IRR, earnings multiples? Like, what are your metrics that you look at when evaluating, like, one, how strong the deal is, and two, the strength of a sponsor, and how important is that for you?
Yeah, I guess on the first part of your question, we are. We're thematic in our investments, and we're not necessarily like IRR driven. We're not looking to exit quickly. I would say on any given investment we make, we could hold it for as little as a year and as long as 15 years, right? Like, it really just depends on the property. We don't have fund life requirements. We don't have, horizons like that. We like to do what's best for the real estate and ultimately what's best for our investors. So what we're trying to look at is typically, an above market cap rate. Can we get there at some point in time? And then can you sell at a cap rate that's the market? And can you create, some sort of, difference between those two numbers, right? And that's how you get your upside and your gain. So on the senior housing side, I'm trying to solve for a stabilized 10% cap rate. So at stabilization, can my NOI divided by my purchase price and sometimes my all-in basis, so it might even be more like a yield on cost, is that around 10%? And if we can get there and we believe in the story, for whatever reason, then that makes it an interesting opportunity for us. We're also very sensitive to price per unit or price per square foot metrics. We want to be below replacement costs, for sure. But look, in today's market, in today's world, it's really easy to be below replacement costs and still be at a really high basis. So I would say we're like, we're looking at replacement costs, but we're really looking at, what's trading too. So for senior housing, for example, we like to be, I would say like between 100,000 and 250,000 a unit. You can't build for 250,000 a unit today. You probably can't build for 300,000 a unit in seniors. Honestly, like in the Midwest, you're probably in like the mid threes, and on the coast, you're into 4, 5, 6, 7. I've heard of developments that are building for $1 million a unit. So, we wouldn't just go to New Jersey and say, hey, it costs 800,000 a unit to buy here, so we can buy for 750. That same 100 to 250,000 units still really applies for us. And we look at office, we look at multifamily, we look at retail the exact same way. We're always in industrial too. We're looking at per square foot or per unit, whatever's relevant.
So as a company, you cover pretty much all bases. So you primarily do senior living, but the company, you guys do retail, multifamily. You kind of just look at everything in its entirety, and it's mostly opportunistic, right? So you want to see the value add. Does that entail ground up construction if you get the right opportunity from a good sponsor, or is that something you shy away from?
Yeah, we don't like the risk with the construction. There's just so much that's out of our sponsor's control. There's so many other things happening, right? You have to wait like 2 to 3 years, if not maybe sometimes more, sometimes less, until you see any cash flow. And just so much can happen in 2 to 3 years, right? So much of the world we live in can change. That plus you got to be on time with your budget. You have to be on cost with your budget. It's just not a risk-adjusted return we like to solve for. And we find that we can look at acquisitions that have way less risk and get to similar return thresholds that are much more appealing to us. So that's why we don't really touch ground up construction. We do touch all asset classes. We're buying distressed office today. In Q4 of last year, we bought 2 million square feet of distressed office in Chicago. We're buying retail today. We're buying manufactured housing. We do a fair amount of that, and we're also buying industrial too. We like small bay industrial, typically a little older product. You can get it, for probably like $80 to $90 a square foot, ideally lower than that. And mark to market type of play. We just acquired a property down in Tampa Bay. That's kind of our game plan, and we're excited about that. So we touch all asset classes, right? We like real estate, and a lot of things can be a part of that. There's probably not an asset class we haven't touched. We just got paid off on a car wash loan, so it's really all over the place. On the sponsor, that's really important to us too. I mean, finding people who are aligned from not only an investment thesis, but also just values and culture, and that want to work with good people with right. Good reputations. Yep. That's really important to us. So we do, you underwrite the sponsor. Sure, I'd say we more vet them. We definitely want to meet with groups in person when we can, and ask around the industry and things like that. So we try to be a little particular on the sponsors. And we probably won't just jump into a deal, even if it makes a lot of sense, if it's not with the right partner.
With the office space, I'm very interested. Is that you guys just starting to believe in office, or are those going to be conversions?
No, they're office, no conversions.
They're going to stay office.
That's probably a little bit too much of a risk for JDI. I think with office, our mindset is that we think the market is near the bottom today. And we think eventually it's going to get better. You look around the country, and a lot of companies, the big ones and the small ones, are requiring people to go back to work, whether it's 3 days a week, 5 days a week, 2 days a week. There's some sort of in-office policy, and it's coming back slowly, right? It's not happening tomorrow. And when you look at the office market today, I mean, talk about dislocation, right? Like everything is underwater. Besides like Class A properties in good locations within certain markets. So. I think for us to get comfortable with an office outside of Chicago, we would have to be really comfortable. But Chicago, we know the market really well. We know the Loop really well. And we invested into 303 East Wacker, which is on Wacker Drive, but on the north side of the loop. So it's on the river, it's on the water, and then it's also further east, so it's pretty close to the lake. So that building, it's really a Class A building. There was a huge renovation project done to it in 2021, a $30 million renovation. Our acquisition price was about $60 million on, around 1 million square foot. So we're in at $60 a foot. That's an area where okay, discount to replacement costs, you got to throw out the window, right? Because to build that building today probably costs, I don't know, $1,000 a foot, if not more than that. But that's a building where there's not a lot of tall buildings around it. And there's no land around it either. So you're not at risk of development. And there's really good views. There's good light. And there's a really strong in-place cash flow today. So that building was, we're looking at a cap rate in the low to mid teens on in place at 75% occupancy. So, if you believe in the location and we're working with, great partners, we're a great sponsor who we really like in that one. And you believe in them, can you do 5 percentage points of leasing? And if you can, and you can do that over 2 or 3 years and you can sell it even at a 10 cap, you're going to be in a good place. So that's kind of the thesis to we also invested into a property that was more suburban, but it was similar. I mean, it was a huge discount to prior basis, a huge discount to, a prior loan. It was a Class A property. It didn't need a big renovation project and you didn't need a lease up, right? That building was around 70% occupied. And again, we're only stabilizing these at 80, 85% maybe, if even that high. So we're not looking to do buildings that have a big lease up part of the plan. It's buy it at a discount, put in all this money and lease it up. I think that's a good operating model. But again, we want in-place cash flow. We want in-place coverage on debt. So both of those acquisitions had debt we put on the property and we're covering it on day one. So, you have to put up some reserves more so for TIs and leasing commissions. But again, we're really cash flow driven. So I would say the same thing really applies to the senior housing side. We want some in-place cash flow. There's a lot of messy stuff out there that needs a lot of turnaround time. Might not be the best type of deal for JDI, but the stuff that is performing well and is a good basis play. That's what we like to get aggressive on.
Mm-hmm. In terms of geography, I remember I had a conversation with you. You were going to California, I believe, to see a deal, right? So are you guys looking at all states, or are there certain states that you don't want to look at? Because I know a lot of lenders, a lot of investors. There's certain blacklist states they have. Florida became that on the residential lending side for a lot, even though there's still a good amount of LP equity going to Florida multifamily and so forth. Do you guys have any kind of red flags when it comes to geography?
Yeah, we're flexible. I mean, we own and lend all over the country. I'm sure there's some states we haven't been in, but we've been in a lot of them before. I like to say my markets choose me more than I choose my markets, because I'm solving for these two things: the price per unit and the stabilized cap rate. They're small strike zones. So when opportunities come up that fit the bill, we'll look at in diligence markets, right? So I don't necessarily have hey, this state and this city are on my target list. But when a deal comes up and it makes sense and the target and the market is okay, then that's when we start to really look at it. So, I was in Minnesota yesterday. We have a deal under contract in Texas. We're looking at one in Florida, right? So it's really, and then we own today in Illinois, Wisconsin, and Michigan on the senior housing side. But, on the other asset class side, I mean, we own stuff everywhere. We just sold out of a property in Spartanburg. We're about to, we're hopefully going to sell a property soon in Arkansas. We have a bunch of stuff in Chicago too. We're based here, but we're really all over. I would say, look, we want to be in primary, secondary, or strong tertiary markets. We don't really do rural stuff, but are the demographics there? And especially thinking about the senior side of thing, is there density and is there affluence is really the two questions we're trying to answer.
Right. And in terms of when you say you guys are purchasing these, right? So you're coming in with a sponsor, you guys bring in the equity as LPs. So the equity that you bring in, is it your own family office money, or you guys syndicate that, or you guys have a fund?
Yeah, we have a fund. So JDI, I would say there's nothing really institutional about us. So we're all of our investors are high net worth individuals who have been investing with JDI since the company was founded in 1988. We have a good track record and people have been happy with us, and they, have kept over the years upped and upped and up. So we have funds that we raise And that's our primary, investment vehicle is out of these equity funds. But there are deals that sometimes won't fit into equity funds, and then we'll do a sidecar. We'll syndicate it out. I would say most deals that we syndicate out, we get our full participation within a day or two. We're usually oversubscribed pretty fast. And again, it's not, we're not going to a wide base. We're going to a very targeted group. Usually if an equity check gets a little too big for us, we'll put 70% of that in the fund and another 30% we'll syndicate out, and we'll go to our fund investors and say, hey, you have the opportunity first, and we haven't had an issue filling it too. Other thing is, JDI, our employees we're all invested in our funds and the deals and everything like that too. So we all have skin in the game, and some of our employees are some of the biggest investors.
What's your typical deal size? Like, what would you say is like a bare minimum equity check that you write, and do you guys have a ceiling?
Yeah, on the bare minimum, I would say we probably wouldn't go under about $2 million on an equity check. And then on the ceiling, our sweet spot is probably more in that $6 to $8 million range. I would say we'll go as high as low to mid teens, and anything above that, again, we would look at it and consider it, but I would say we're not doing a whole lot of $20 million equity checks. That makes our deal size, I would say, be in the $5 to $30 million range. Look, in seniors, that's intentional. We're trying not to compete with some of the big institutional groups out there who have lower cost of capital than we do, and more capital than we do, candidly. So we're trying to kind of carve our own little spot. And I think the same is true in industrial. We're trying not to compete with some of the huge people out there. The issue you run to is you're going to have a square footage issue or a unit issue too at some point in time. So in seniors, I don't know how many $10 million deals there are out there to be done, because we're not looking at properties that are, under, 80 to 90 units really. So it's hard to really get under that threshold to begin with. Obviously with some other asset classes, a little different, but we're kind of, I would say in that 6 to 8 million is where we like to play.
Very interesting. And when it comes to, so you said your journey is very interesting, right? You pretty much did everything you can in terms of the skill set in real estate, right? Whether it be acquisitions, working for a REIT, working for, the financing aspect of it. What's the part that you enjoyed the most? And is there a part that you pretty much set and focused on, and then the rest is handled by the rest of your team?
Yeah, no, that's a good question. I was actually talking about this yesterday with somebody. My journey in real estate, my first company I worked at was 2,000 people. The second company I worked at was, probably a couple hundred people. The third company I worked at was a couple hundred people. But my team and really my, the senior housing aspect of that was really closer to 50 or 60 people. And now JDI is 15 people. So I've gone much, much smaller as I've gone through my career. And I like that. I like being somewhere smaller, nimble. You get a lot more responsibility. I would say there's a lot less of a job description. You kind of just do what you have to do, get thrown in the fire. That's how you learn. That's what I like. So that's what I've really been enjoying that. And then in terms of the type of work I like to do, I came over to JDI and initially was probably going to be doing a little more asset management than acquisitions. And because the opportunity in seniors presented itself so much, my timing has really shifted from all acquisitions to, and really, on the deal, we're cradle to grave at JDI is what we like to say. So if you're sourcing and finding a deal, you're seeing it through to the exit. So any deals that we've done in the senior space and that I've sourced, I'm also going to be running the asset management on that. On the acquisition side, I really enjoyed the relationship making. You have to talk to brokers, to operators, to sellers, really to everybody. Going, doing the conferences and all that. It's been fun. And then you also get to do the analytical part of it, right? You get to do the underwriting, you get to do the analysis, you got to learn about the markets. You got to talk to a lot of people when you're doing that too, right? It's kind of you find a deal you like and you got to make 15 phone calls, right? Which is fun. So I've been liking it a lot. The acquisitions is newer for me. I hadn't done it before JDI. So I've been doing it for a little over a year now. I also love the asset management part of it. That was especially in seniors, that was a really great skill set of hey, you have to learn how to operate a building and speak finance lingo and really connect our operators and our investors and oftentimes act as a bridge between the two. And if I was going to lower market rates or raise, wages for one of our properties, I had to know how that would affect our IRRs and our equity multiples and returns. So that was great. I would say asset management, I think, has made me a lot stronger of an underwriter on the acquisition side because I've just seen it through it all. And I think a lot of groups and people out there, and again, I feel like there's two different philosophies. You can either have people who do everything, or you can like separate it out acquisitions and asset management. I lean to the having some overlap. I think if you just have an acquisitions team and you're handing it off to an asset manager, it's really easy for that acquisitions team to forget that they underwrote insurance to be $1,000 a unit when it should have been 4,000 a unit, when they didn't think taxes were going to go up, when they didn't think all this stuff. And then it's hard to remember that, but the asset management team, they see that out. So I like the acquisitions, and I like that I can bring my kind of asset management hat to it. I think and hope, I mean, look, I guess we'll see. It's only been a year now. I think and hope that it can make me, a stronger underwriter.
Yeah, absolutely. Especially that remark you made about insurance. We have a couple of properties in Pasadena, Houston,
Mm,
and since the Houston flood, the insurance skyrocketed. Right, I think we underwrote 1,000 a door, and then it went up to 2,500. And last year was 1,500, thankfully. And then we actually got very good news last week that it was like we're getting it 30% cheaper. So insurance costs are starting to come down a little bit.
nice.
But yeah, like you said, like you underwrite 1,000 a door, and then next thing you know, it's 2,500, 3,000. The asset manager is looking and it's like, hey guys, you gave me this asset, now my cash flow is not meeting my liabilities.
For sure. And look, some things are out of your control, right? Like you couldn't have predicted a flood. And if you look to
No.
seniors, nobody could have predicted COVID-19, right? And how
Yeah.
that's changed the industry so much. And you couldn't underwrite for that. You just couldn't. So, it's a give and a take on that side for sure. But the insurance market does seem to be softening a bit, which is great.
Yeah, absolutely. I mean, for a while there, it was very scary, especially in areas like Texas, Florida, the southern states. It felt like it was going to be growing 30 to 40% indefinitely, which
Forever.
was going to make it. Yeah, obviously nothing ever happens like this, but when you're in the midst of this and you're looking at these numbers and you're trying to figure out, you're speaking to one broker, one insurance company, the third, the fourth, the fifth, and everybody's coming in higher than you could have ever imagined, it becomes scary. But thankfully, we were able to keep the properties, and now things are kind of circling back.
Yeah, a
Um,
lot of companies weren't so lucky. A lot of deals just went bust simply because of that and taxes. So yeah, I think we got off pretty good. It's not the IRR isn't what it was supposed to be, but at least we have the property and we'll make out.
Right. I
When
mean, and, that's that point. That's like the JDI philosophy, right? That's why we like buying stuff which has cash flow at above market cap rates. So our worst case scenario isn't an equity wiping, but is a 1.0 return of our equity, right? We just think if you're buying at very low cap rates and then your insurance is higher than you thought, then what do you do? Like not everything can be absorbed in the rent. So that's
Mhm.
kind of goes to our kind of investment philosophy is that point right there.
when you underwrite your deals, like is it 100%? Okay, let me just look at the numbers, make sure they work, or is there a gut feeling that plays into account, or any kind of intuition that plays a role, or is it strictly the numbers need to look a certain kind of way in an Excel spreadsheet, and that's what we're going off of?
Yeah, I mean, so I think what I learned about real estate and what I love about real estate from asset management is you have to see the properties. You can only learn so much behind a computer, no matter what part of the business you're in, whether you're in the accounting and finance side or if you're working on something a little more property level facing. It's really important to be there. So look, the numbers are important. And they definitely, I would say, give us our backbone. Does this even make sense at a high level? But JDI and me, we would never do a deal without seeing it, whether it's on the equity side or the credit side. We need to see every property before we acquire or lend on it, and we also would do regular site visits after that too. So numbers are good and all, but I would say when you're walking a property, and I think especially in senior housing, other asset classes too, but you can feel pretty quickly if this is a good or a bad operation. Are the residents around? Are there activities happening? Are people happy? Can you see people, right? Or are you touring an 85% building where everybody's 90 years or older and nobody's around? Like that's weird. So it's pretty easy to tell when you're walking through the building. I would say, the feeling of it, and that's really important too. Also, the look pictures only go so far. Pictures can get outdated really fast. And I always like to say when I tour a property and it looks like the pictures I saw, that's great. Like that's what I want. I don't need it to be nicer than the pictures, but I don't want it to be worse than the pictures too. And that's a big part of real estate is how does a property look and feel? And if it doesn't look and feel the way you want it to, it's going to affect your model, right? That's going to affect your underwriting and your basis and your purchase price, right? So it's a big part of it. So I would definitely say, the numbers they're only half the story, maybe more than half, but the look and the feel are really important. And on real estate in general, like I love just like looking around so much so to like when I walk around like Lakeview in Chicago with my wife and we're just like, I'm looking at properties and whatever, she's like yelling at me because she's like, why aren't you paying attention to what we're talking about?
Every
And she,
single person we know in real estate has the same issue. Everybody. It's just truly fascinating. It's a very special. It's a really special industry.
yeah, and she's not yelling. I should clarify that, but it's hard because it's just so interesting to me to look around. What's the story behind that building, behind this one? And again, you can't really get that from the numbers.
No, absolutely not. That's one of the reasons we kind of started this podcast. Is we'll be walking around and we see a development that goes up. It's like, wouldn't it be nice to know who the developer is? And I mean, like, really personality wise, knowing the person. It's like, you see the name of the company and the LLC, but you don't really know the people that are behind it. And for us, it's very interesting. Like real estate is a very small circle. It's a people to people business. A lot of people think that you just look at Excel spreadsheets and numbers every single day, but I think deals get done through relationships. Like, even for you, would you say that even the deals that come across your table, you nurture those relationships with those brokers, right? If you're not going to loopnet.com to find a property to buy.
No, not at all. And it takes work to get on those brokers lists. And, a lot of stuff, I don't know how much I believe in anything off market. I think a lot of stuff is very selectively marketed, and that's real. Even just to get on the top 5 or top 10 or top 30 list, I mean, it takes a lot of work, right? And you're right. The handshakes and the in-person stuff, it goes a long way. And I think that's why, I mean, that makes the industry fun, right? And, I feel like some people sometimes dread going to a conference, you got to go meet all these people, but it's always worth it. And when you always leave, it's always like, this was the right decision for me. And, you're right. That's how you get deals done, right? And it is about the handshake. It goes a long way.
Yeah, like I always tell my brother, like if there's one person that you leave off of a conference you made a genuine and good connection with, that was a successful conference.
Worth it.
Do you go to a lot of conferences yourself? Like,
Yeah, I try to. I would say the big senior housing conference is called NIC, NIC. That's twice a year, so we're always there. There's some other conferences that are more local that I'll go to. There's some other deal making conferences I'm thinking about going to later on in the year to try to drive some source and lead generation, I guess. But yeah, conferences are important. They're important for JDI. I mean, I think if you're somebody new starting here, the one thing that you'll never get questioned about is an expense report or asking to go to a conference. Like, there's so much value in going out and meeting other people, be it your age or not, but just getting your name out there. And that's really important, just getting your career started and even not your career started, but just advancing it in general. So yeah, I like it. And I do feel like every time I'm like, get a little nervous or whatever it is, a little bit of anxiety of going there. And then the second you walk in that room, you're like, it's fine. I'm glad I'm here.
so when you go to these conferences, do you break it up into 30-minute slots? You schedule meetings ahead of time, or do you mostly just go in there with open hands and just like, okay, let me just see who's out here, let me network with people? Because I know two types of people. One that are just winging it, and the others are so specific. They have like 15 to 30-minute increments with all these different companies they're setting meetings with. Like, what's your approach to networking at these events?
Yeah, look, I think there's a balance, right? And depending on the conference, what that balance is should probably change. So for Nick, which are the big senior housing ones, that's back-to-back 30-minute meetings for like 2.5 days straight. And I try to be pretty calculated and strategic with who I'm meeting with, what's the purpose of this. Obviously, it's always nice to catch up with some friends. You can throw some of that stuff in there, but a lot of that can be done after the conference too, and on the night on the events in the evening. So I would say on those, I'm maybe a little overbooked most of the time, and I'm like always trying to leave lunch open. And then it's like somebody's asking me for a meeting. I'm like, this is probably a good meeting. All right, let's do lunch. And it's like all of a sudden you're trying to find 30 seconds to run to the bathroom. So that's one way to do it. But there are other conferences, like I'm going to Interface conference in Chicago in about a month, and that's the speakers are going to be good. The agenda looks really good. And that's something where I probably won't set up any meetings. I'll probably just go and actually try to listen to the speakers, learn something. And then there's obviously events of the conference that are more like the open, happy hours, whatever. And that I'll, just go in with an open mind. I will say, like, the conferences, being on the circuit, doing the evening events is important too. Trying to get to dinners and go to whatever the big broker is that's hosting the event. Those are important to go to also. And it's important to, to have some fun and a little less business oriented conversations with these connections you're making too.
100%. Now, let me ask you this. So you network with brokers, operators, right? You guys come in with equity. So when you're partnering with a sponsor, they bring the deal, they spearhead the deal, they're the operators. Now, when you are networking with a broker, do they send you deals directly? And if so, do you have an operational platform from within where you do it without sponsors, or do you say you like a deal and then you bring a sponsor to kind of to operate it?
Yeah, so it's the latter. So I'm looking at deals pretty much solely from brokers. I mean, I get some from operators, and it's always great when a sponsor, an operator comes to me and says, "Hey, we have this great deal. Here's why we love it." You know, that's easier for us to get behind typically versus me looking at an OM from a broker and deciding, "Hey, is this worth my time or not?" And trying to decide is my pricing going to be worth the broker's time or not. I will tell you, it's not always there. So that's always a challenge. But yeah, no, we're doing direct stuff, and a lot of times I'll find a deal and then we'll go to an operator, and I'll for senior housing too. I find some importance in the regional operators, and I think that's there's value in that, and being with a group who's managed properties that are in that market or in that state or in that kind of region before. So if I see a deal in a certain place, I'll go and talk to operators who are experts and well respected in those certain markets and say, hey, what do you guys think? Do you guys like this? Here are my numbers. What are your numbers? Let's compare them. I always do my own underwriting. I want to see the operators' numbers and the sponsors' numbers, but I'm always going to underwrite a deal myself and then compare the two and see where we're off. And that usually is a good starting point for a conversation with them too. And I'm not always right. And neither are they. Usually there's a balance of it too. And obviously there's some things that I won't be able to kind of pinpoint down as well as other people will. So there's a good balance of that. So yeah, we're pretty much direct with brokers, and we'll do deals where we're 100% of the equity and we bring in a third party operator.
That's amazing. I mean, these sponsors must love you. You bring the deal and you bring the equity. So you solve everything. I mean, I must become a operator, work for you guys.
I wish it was that simple. But look, we care about our reputation, we care about our relationships, and I think that the groups JDI has worked with, would have good things to say, about us as a result.
Is there
Go ahead.
sorry, Farrukh, is there a specific deal that you say that like kind of shaped your mindset in terms of how you look at deals going forward? Like a deal that kind of fermented and shaped your mindset?
Yeah, that's a great question. I feel like when I was at Anthology in CA, we had these two properties in Richmond, Virginia that we were developments, and they were new opens, and there wasn't a lot of institutional money in those markets. We were kind of the first group who was partnering with a big institutional group to come into those markets and build like Class A private pay senior housing. We were really nervous about it. Richmond is not necessarily like on people's target market list. If you ask somebody where you're trying to get into, those deals were our best deals we ever did because of the lack of institutional, investment into the markets. There wasn't that much competition. So we put these beautiful properties there, and we had good operators and good teams, and they just filled up so fast and they performed really well. And even when there was like turnover at the property level with a sales and marketer or with an executive director, it actually didn't slow down occupancy or NOI performance because the markets were so strong. So I feel like that deal was really helpful to me to think about, okay, when I'm looking at new acquisitions, your comp set, it's really important. Where you sit relative to them is really important. Where you're priced relative to them is really important, and really going to tour them. So like yesterday I was in Minnesota, I toured our property, and then I went to, 4 competitors after that. And so my whole day touring comps during the market and walking them, right. And really giving that time into it. So I feel like those are two deals, both those Richmond deals where you really learned a lot about, okay, even if things don't go right, and we had some issues at the properties from an operational perspective, but everything, like ultimately the market was so strong that it overcame any issues we had. So that's a mindset I, try to take here. So if I'm looking at, an opportunity, a deal, and it's in a really competitive market and that competition is not well occupied and the rates are low, I'm probably not even going to consider the deal, even no matter what the basis and the cash flows. I mean, maybe depending there, but that's really going to scare me because then you just have such a big downside.
Yeah. Yeah, that does make sense in terms of, so basically it's almost like you want to make your money on the buy. You want to make sure you go in there where like drop in NOI is not killing you, and whatever comes up change, because like you said, especially in senior, you're just not, it's not just property management, right? You have staff that's on site, that's the restaurant, the whole, the hotel aspect, the so it's a big operational aspect to these acquisitions.
Yeah, I mean, we certainly believe in the basis. I don't like to say we're a basis buyer because I feel like that like carries a negative connotation. But ultimately, like that's what we believe in, right? We believe in buying at a good basis. I don't think that makes us a bottom feeder necessarily, but it's important to us. And then you're protected if things go wrong. And whether it's in seniors or any other asset classes, we found that protection has done us and our investors, a good thing during tough times.
Do you ever follow up on your deals where you see a deal that you passed on and then it does well and you regret it and you say to yourself, shit, like I wish I'd done that? Or do you just let go? You have no idea how they perform, who the sponsor, who bought it, what they're doing with it, how well they're doing, or do you let those linger?
Yeah, no, I always follow up. It's important to follow up. Look, if I'm in the market trying to buy properties, I need to know where the properties are actually trading, right? I need to know what people are paying for them and how they're underwriting it too, because not that those people are like my competition, I wouldn't say that, but just to get a better feel of what other groups are doing is really important. So I always like to follow up. We definitely passed on some deals that you follow up with the broker, and then somebody who works at like the sponsor, the equity group, and you're like, hey, how's it going? They're like, 6 months in, and we already realized our whole investment thesis. We're probably looking to sell next year, and that happens, right? And it doesn't make me regretful at all, right? Because ultimately, they took a risk, and that was good, right? And the calculated risk, and it worked out for them, a risk that we weren't willing to take. I think the deals that don't do as well are probably a little less easier for those people to talk about, so you hear about them a little less. But I think for us, like, we think about minimizing risk when we're looking at our investments in the buy, right? And that's going to drive a lot of our decision making. So we pass on a ton of deals, and probably good ones too. But I like to think we pass on more ones that just aren't for us versus it being a good or a bad deal. It's like, okay, there are plenty of 7-8 cap deals out there today that I think are good deals. But that doesn't necessarily mean they're the right deal for JDI.
Yeah, absolutely. And what would you say is one misconception? Because senior living is such a niche within real estate, right? So, if you were to go to, ICSC, out of 100 people you meet, you'll be lucky to meet one person who is in senior living, right? So, what would you say is the biggest misconception about guys like yourself who are, in this niche real estate market?
Yeah, I mean, I think the biggest misconception is what I spoke about earlier and why I didn't want to take an interview to do senior housing, which is that it's all skilled nursing, right? It's definitely a big part of the business, but it's not everything. And skilled nursing can be an extremely interesting, lucrative, and exciting place to be in a great industry, just not one that I'm familiar with, and therefore JDI doesn't play in that space. But I think all people thinking that senior housing is kind of what you see in like the Happy Gilmore movie of that representation of an administrator yelling at people with arthritis to pin needle whatever faster. That's a misconception. Like, some of these properties that we're buying, some of these properties my whole company was building, that the industry is building, I mean, they're beautiful, incredible buildings that have great activities that are you have a lecture series coming in from the local university. You've got really engaging speakers coming in. You have live entertainment multiple times a week. You have happy hours. You have all this stuff. Like, it's really a community. And there's a lot of value in that. And there's a lot of value in, I would say, like, giving people purpose. And I think you walk into some of the newer vintage of buildings today in senior housing, and it gives a lot of, our aging population some purpose, and some excitement. And that's great. I mean, living alone is hard. Even if you're getting a caregiver to come in and help you a couple times a week, every day, it's different than being around people your age. It's different than going to, play cards or listen to, the singer coming in, or listening to a lecture series on whatever, that it's just different. It's really stimulating. So I'd say that's probably the biggest misconception. I will tell you, I don't think my friends have like any idea what I do. So I feel like that misconception I can't even start to talk about. But at least within the space, that's that. I'll tell you something that's not a misconception, is that people think that senior housing is an operating business, and I think that's true. It's also real estate, but it's definitely an operating business, and it's different than an industrial building, a retail center, a multifamily building. There's no triple net leases here, right? These are people's lives, and it's complicated, and you got to staff 50 to 100 plus people per property, depending on what phase of lease up you're at. It's definitely an operating business. It's a lower margin business as a result.
So one thing you cited was the aging population. Would you say that the current inventory of senior housing is able to meet the aging population's needs in terms of just being available space for them to go to?
No, there's nowhere near enough supply, and that's part of the reason why JDI is so focused on the space. I mean, basically, in order to keep up with current demand of the boomers who are starting to age now, boomers are just turning 85, and they're our wealthiest and largest generation. In order to keep up with demand, we have to build like over 100,000 units of senior housing per year by 2030. At the peak in the heyday of like the late 2010s of like 2016 to 2018, the most senior housing units ever delivered in one year was like somewhere around 60 or 70,000. So we need to build 100,000 a year. The issue is that right now construction costs are so high, and you could buy at such a large discount to replacement costs that like a group like JDI won't even consider development. There are developers who won't develop too because they can buy nice properties for $150,000, $200,000 a unit. We're on pace to deliver like, I don't know, under 10,000, around 10,000 units this year and next year. At the NIC conference in March, they were speaking, they said there's going to be a quarter in 2025 where there'll be zero new construction starts in the country, like zero, right? That's a real number. So, we need 100,000, over 100,000 a year. We need 500,000 units by then. We're probably today on pace to maybe do 100,000, maybe 20% of what's needed. It's probably less than that. So there's a unique opportunities like, also buildings that are, into the low 80s on occupancy. We think there's a really good, narrative and story for why those occupancies can get up to the 90s pretty fast, especially with the lack of new development coming in.
Do
So what
you
would you
ever
say
see? Go ahead, Fran.
So what would you say the cap rates are not subdued? I would think that if there's no new developments and there's such a big demand, right? I would think the cap rates would be very small on senior living, and I would be surprised to see a property at 65% occupancy if there's such a demand for it. So what would you say is one of the reasons why, with such a demand and people are looking for senior housing to be able to enter them, you still are able to find properties that are having smaller occupancy percentages?
Yeah, I mean, so I will tell you the cap rates are compressing for sure. But the thing is, it's for Class A properties and Class A markets because there's just it's a niche industry to begin with, and a lot of investors have been on the sidelines the past couple of years because dealing with their own portfolio as a result of COVID, and not necessarily as like a result of deaths from COVID, but I think it's a lack of people were moving out and there weren't people moving in because of the stigma affiliated with senior living, and also just like a basis reset. That all these groups are flocking towards the best products in the market. But there's not necessarily as much demand for the stuff that's maybe instead of 10 years old, or maybe it's 10 years old instead of 5 years old. And especially the stuff that's 15, 20 years old, there's just not as many groups who will take it seriously because they can go buy the stuff that's way newer and at a slightly higher basis and a lower cap rate. And they believe in everything that, you were kind of just alluding to. And they're like, look, if I'm buying at a 6.5 cap today, I can see that getting to an 8 pretty easily, and that's going to be in good shape. So I do think there is a ton of cap rate compression, but it's really only for the Class A products that are stabilized in Class A markets. There's not as much patience for the properties that need a little more time to season, that need a year or two, that have to have an occupancy change, that need an operator change. I mean, that's the other thing about the senior housing is there's a lot of great operators out there, and there's a lot of operators who maybe aren't doing the best job in a specific building. And it's such an operations intensive business that by making an operator change, you oftentimes can realize a lot of value. But again, a lot of groups just might not be willing to do that. It takes time. You got to usually change the name of a property. You might have to deal with reputational issues in a market, have to just get market share in general with a new name. Again, these are operating business issues that people in real estate don't want to deal with. So
Right.
they're not going to do that. So we believe there's this unique opportunity, for deals that are not necessarily, stabilized and in incredible markets. Granted, those deals do exist today and they're trading at very low cap rates. And I think in 5 years from now, we're hoping anybody who bought anything is going to be looking back and thinking it was a good investment.
Do you see any office to senior housing conversions like taking shape in the near future?
It's tough. We operated one at my last company, an office to senior conversion in Kansas City. The inside of the building was beautiful. The outside of the building looked like an office building, and that was a barrier. That was tough. So, there's only so much you can do. I think with office to senior, you're gonna have the same issue with office to resi. With Lightwell and with you need big floor plates are bad, and high rises aren't always good, and the cost don't make sense. So I don't know how much. Ultimately, look, if you're driving to take a loved one and you're touring the market and you want to move one of your parents into one of these places, and oftentimes the adult child is making that decision. You're going to drive up to 4 or 5 places. The one that's like nicer looking and looks like an apartment building, even if the inside of an office building looks nicer, I feel like it just might feel weird driving up to an office building to move, your 85, 90-year-old mom or dad into that building. So I don't see a whole lot of opportunity in the office to senior space, but I would love to be proven wrong.
Yeah. I love your whole viewpoint on senior housing. You have such an optimistic view about it. Oh, they have all these activities, they make new friends. For some reason, I don't know if it's because I watch too many movies. My viewpoint of senior housing just gives me anxiety because every time I see a movie and there's somebody just like an isolated person just sitting in the corner and everybody's neglecting them. But I'm glad that's not the case in real life.
No, it's a real stigma, and I think that stigma was only exacerbated during COVID when people thought that if you moved mom or dad into senior living, they were gonna die of COVID. Which wasn't the case, and it's hard to get over. I would say as the generations get older, my purely like this is intuitive. I don't have data to back this up, but I feel that as generations are getting older, they're more open to living into senior housing places. For example, like my grandfather lived in senior housing in Chicago for like 5 or 7 years before he passed away. And he was kind of always hesitant to move in. He didn't really want to move in. After he did, he was super happy and like it was a great experience for him. But my parents who are, in their 60s today, they see the properties that like I'm buying and they're like, can we sign up now? They're totally open to it because they have movie theaters, they have swimming pools, you have quartz countertops with stainless steel appliances, you have huge dining rooms with 3 chef prepared meals a day, you have the activity rooms, you have beautiful outdoor spaces, you have little mini putts, some have pickleball courts. There's a really nice amenity package that is driving, I think, a generation into these properties that I think will get rid of a little bit of that stigma. And when you go visit mom or dad, or if you're a grandchild going to visit one of your grandparents or great grandparents, if you're really young, it's going to be a nice warm place that you're going to, and it's going to feel different than like the movies of the 90s and 2000s.
It's funny you mentioned that the community aspect, right? So because our generation specifically, right? So we went from like community offices, which is WeWork, Regis. So now there's community living spaces, right? Where you're living with roommates and you're sharing, you care about the amenities and you care about the pool in the building as opposed to, you want to have a separate apartment just for yourself, just because you want to be around other people. And as this population ages, this generation, our generation, and then especially after our generation, they always want to be around and doing things. I think they care more about the activities and being around people and being always outside. We always talk about it like we have a building next to Soho, and the bedrooms are very small, right? And we never have an issue renting it because it's young people who just want to be next to Soho. They
Right.
want to be outside. They want to be in Cipriani. They want to be in Jimmy's rooftop. They want to be hanging out. They don't care where they sleep as long as they're in that community of other young people. And the same thing with the elderly, like you said, like you go in there and now you have somebody to play cards with. You have somebody to swim with. You have somebody to exercise with, which is a refreshing point of view compared to some of the movies, the way they point things out to be in senior living.
Yeah, I totally agree with you. Like our generation, we're not buying houses. We're living in these highly amenitized buildings. Like what's going to happen when we're 80 to 90 years old, right? Like I think it's going to be similar, right? We're not going to have the same stigma of like wanting to live in our home forever because I think there's a lot of people in our generation who are going to get to 80, 90 years old and maybe have lived in an apartment building their whole lives, right? And that's not that crazy. So I think as the generations continue to age, I think that the attraction is only, or the appeal, I should say, is only growing. But it's interesting because, I don't know, all my friends, like we're just starting to move to the suburbs now, all of my friends, because they have kids, but for the most part, all in the city, and they're all in apartments or apartment buildings or buying condos and condo buildings. It's different than, 30 years ago.
Yeah, absolutely. And one other thing you mentioned is, you're at a company now with 15 people as opposed to a company where you had 2,000 people. So you assumed a more leadership role and a mentorship role. Can you tell us more about that? Because I think that you're big into that, right? Like building up your team and mentoring and picking other people up.
Yeah, no, definitely. Yeah, I mean, I like that. There again, at being at the 15-person company, we are very horizontal. I will say that, but there are definitely people, who I mentor from and I mentor to. Right, there's a lot of that. I would say more so outside of my outside of work, outside of professional. I spend a lot of time with mentorship. I do some stuff with University of Michigan Economics Alumni Center, with the University of Michigan Real Estate Center, and I do some stuff with JUF, which is a nonprofit here in Chicago. Do some summer internship stuff with them and mentorship opportunities. Um, and people reach out to me a lot, and I always like to network and talk to people. I feel like it's so important to give back to that generation because my first job out of college was in brokerage. And very quickly, I learned I didn't want to be a broker. I wasn't good at it, and I didn't want to do it. I'm sure those are related, but it just wasn't for me. And I had to get more to like the finance and investment space, and it wasn't necessarily an easy transition. And anybody who would respond to like a LinkedIn or talk to me, I was just so grateful for. And I feel like it's so important to provide that experience back to the younger generation because I mean, you just never know what somebody had to go through to get into their spot. And we talk about a lot of things, but leveling the playing field and making sure everybody has equal opportunities, like that's one way you could do it, right? Like people reach out to me and I'm always open to that conversation. I'm always happy to talk because it's important for people who are younger to hear and to listen to people who are honest to them and get some some guidance. I would say like the thing I tell people I talk to the most who are a little younger is and granted I'm still young in my career too, but I always say it's so important to ask questions and reach out. Like somebody who'll reach out to me and they'll say, hey, any advice? I'll be like, yeah, you're doing the right thing. You're reaching out to people on LinkedIn you don't know. You're reaching out to people you do know who went to University of Michigan or wherever you went to school. Like that's such a big first step, especially if you want to be successful in real estate. But I think curiosity and like welcoming, question asking, and that is so important just for learning. That's how I learn. I ask a ton of questions. So again, maybe it's like, okay, if this is I'm annoying and this is how I do it. So at least somebody else shouldn't be thought of being annoying for doing that. But I really like it, and I like to help out. When I can, and provide some guidance. It's honestly it's fun.
Did you always have that aspect, like that feature about you where you like to do that? Because I feel like there's people who I think it's something you're born with. It's either you have it or you don't. Was there a specific time where you're like, I do want to have a conversation with people. I do want to help them out, or did you just always have that and you just don't know of a different way?
Yeah, I mean, I think I was probably raised to really, emphasize and prioritize giving back, and I think I've taken that with me. So I don't know if maybe I was born with it, maybe it was taught to me, but it's important to me that I can tell you. And I think I've always liked doing that. I've always been involved with different nonprofits here in Chicago. I sit on a handful of boards for a bunch of different nonprofits. I like to give a lot of time back when I can, especially when I was younger and it was easier to give time than money. That was really important. And now obviously as we all get older in our careers, there's a different ask a lot of the time, and that's important too. But I think, giving back was always something that, my family, my community was like, top of priority list. And I took it with me to college. I took it with me back here in Chicago. And I get, real enjoyment out of it. And it's fulfilling, and that's a big part of it too. I, after work most days, have something going on, whether it's a board meeting or volunteering something or this or that. And, I don't know, maybe I like to be busy, but I really do enjoy it.
Very nice. So
Go ahead.
So you mentioned a lot of times so I assume you went to Michigan.
Yes, yeah, I know. People from Michigan don't let you go 10 minutes without knowing it. We're at minute 57 for the record.
It's funny. I always so I'm a big football fan, and
Okay.
you guys are notorious for your college football games. That stadium, what's the capacity? Somebody told me it's over 100,000 people, right?
110.
110. Holy,
It's an experience. It's to go watch a game there. It's a blast. It's cool.
that's
Talk about
insane. What?
community. It's like such a it's funny, like people who went to Michigan, we have all this, and it's a real community, but like we don't know each other. So I don't know. We were talking about with seniors before. It's just like, it's a real sense of community. You're in this building with 110,000 people all like rooting for a ball to move down a field to get into an end zone, which is, kind of silly when you think about it like that, but it's fun and it's a good time. And you have this sense of, belonging, right? And that's important. And I wasn't trying to bring this back to senior housing, but that is really what you get when you move into some of these places. So when you look at that stigma and going away, it's that sense of belonging. So yeah, I mean, at Michigan, we definitely like to feel that way.
Yeah, that's what I'm saying. When I used to work at JP Morgan, there was a girl, she worked in HR and she was from Michigan. And I don't think it was a day where she didn't mention the word Michigan. So you guys are dire. So I can tell if a
We
person's
should
from
be
Michigan.
friends.
Yeah, within the first half an hour, I can tell that somebody's from Michigan. So that's interesting to know. Is there something like during the day, like so a lot of times, we get in the chaos of real estate, right? Looking at deals, underwriting, Excel spreadsheets. Are there certain things during the day that are out of normal, something that makes you happy that you kind of like look at and what you do to take your mind off of the chaos that is real estate and numbers on a daily basis?
Yeah, I mean, this is not something I've been doing before JDI, but here at JDI, what we do for that is we all eat lunch together every day. So all 15 of us sit in like a table right outside over there. There's a table that's big enough for us all to sit at, and at 12 o'clock. Mostly today, lunch was late, and there's a lot of havoc in the office as a result of that. But really, most days from like 12 to 12:30, we'll all sit down and just talk. We'll talk about real estate. We'll talk about politics. We'll talk about what's going on in the world. We'll talk about deals. It's really kind of all over the board depending on the day. But that is a nice break, I would say, to take our mind off of things. And we're in the office 5 days a week. We find value in it as a company. I think it is valuable. I understand I understand hybrid working as well, and I see value in that too. But for us, we're all here every day, so it's like, let's be intentional with our time. Let's all make sure to spend time together. We're all in each other's offices or desks all the time, but like, okay, half hour every day, like you kind of have to be at lunch. Obviously, we all take lunch meetings, we travel, whatever, but like that's kind of sacred JDI time. I mean, it's important. I will say after lunch, we do play ping pong for like 10 or 15 minutes usually too. So it's fairly competitive. So that's a good way to just get moving a little bit, take my mind off of things, And I would say like, beyond that too, I mean, that's why acquisitions can be pretty fun is, setting up a call to talk about a deal. Like, I don't view that as work. It's like, oh, you're going to run me through the deal, the high level, talk about the market, catch up a little bit. That's fun to me. So I think that's probably why I've been enjoying it a lot. But I do like breaking up the day with some meetings, so you're not just deep into the numbers or the documents all day.
Is the founding partner still active in the business?
Yeah. So Jeff Ader founded the company in 1988, and he's our president. He still runs the company day to day. He has a few principals that have been around for a long time. There's 3 other people who are principals alongside him, and all have different kind of functions at the company. But Jeff really runs it from the day to day. He's the leader, he's in the office here every day with us.
Does he play ping pong, or he just watches you guys?
He is very competitive, but and he'll probably kill me for saying this, but ping pong isn't his best sport, I will say. So he doesn't like to play sports that he doesn't win.
I love that.
You can find him a lot more often probably on the golf course than the ping pong table. But we get some participation. We actually. Like, we take it seriously. We're just finishing up the Ryder Cup for ping pong. We had an invitational, we had an open, and the Ryder Cup is like first to, I think it's 14 points or 14 and a half or something. And we got Jeff on one of the teams to play in the Ryder Cup. So he'd at least play a match and feel like he was counting towards one of the teams.
Interesting. Ever since you mentioned that the company opened in 1988, and that's the year of my birth, right? So I'm curious, did you happen to incorporate November 30? You probably don't know, but I'll follow up, I think, after this podcast. I'm very curious what day you guys incorporated. What a coincidence that'll be.
I'll check.
So now that you've done acquisitions, asset management, what would you say is the next step for you? Like, how do you see your career progressing? Like, what would you want it to look like in 5 years?
Yeah. I'm loving being on the senior housing investment side of things. I would say at my last role, I was definitely more in asset management through exit and then trying to, find recapitalization opportunities and a little bit on the acquisition side. But I do like seeing the whole investment kind of through and through. I've only been doing it for a little over a year now. So I would say I've got a little more time before I can think about, probably what's next. But I'm really liking the path that I'm on right now. I feel really good about the direction I'm going in, that we're going in, the opportunity that JDI has provided for me. I feel great about it. So, 5-10 years down the line, it would be great if this only continues to progress. And, today we own 7 senior housing communities, 900 units. We've got another 100 units under contract, 1 property. And we're looking at, a whole bunch of others, ideally in the next, couple of years, that number is 15, 20 properties, maybe even more. It's really overseeing a larger portfolio, both on the buy side, on the sell side, and really everything in between. I think would be great if 5 years down the line it's only continued to grow and there's more of a team. We're looking to potentially bring some additional help on right now just to support senior housing. So there's some real growth here, and it's still early on.
Do you guys have metrics that you go off of, like when we want to acquire 200 more units every single year for X amount of years, or is it just we just want to see good deals? We don't operate under a structure where we need to allocate capital towards certain deals. Like, what's the strategy of growth like for your company?
Yeah, but we don't do a lot of like, hey, we need to do this amount in this amount of time, because that's how we feel you can run into trouble, right? That's when you can maybe make an investment you shouldn't be making. So we don't do that. It's just not the way we do things. We also don't have, pressure on our equity to go out, because a lot of it's raised, and our investors are patient. They're high net worth individuals, and if the capital isn't being called like today, that it's usually okay with them. Obviously, you do want to put out equity. But I think with senior, we see great opportunity, and we'd love to grow the portfolio to 15, 20 properties if we can. We're going to give it our best shot and try to do that. And if we can, it's going to be okay, right? Jeff will say he likes to invest in what's out of fashion, what's out of favor. Mm-hmm. Today, that's senior housing. We're also a little bit of office, though not necessarily definitely not as much allocation to senior, small bay manufactured housing stuff, small bay industrial and manufactured housing. Are that. So no, we don't have allocation requirements. All of our funds are completely diverse, mixed property asset classes. And we really do the deals that make sense regardless of the asset class or type. But again, right now, seniors is just providing such a great opportunity for us because we're getting really nice returns and yields and, on a risk adjusted basis.
Interesting. So it's basically, this approach is very. It's funny when we talk to companies, right? How one company can be very different from a different one, and I think your approach is correct in what you said. Is you don't get into trouble because you have to allocate. Even when speaking to private equity companies, right, that raise funds to purchase businesses, right, it's a 10-year fund. By year 5 they need to allocate pretty much all their capital, otherwise it's a problem and the person didn't earn a return, and then they're going to have issue raising money on their next fund, where not having that pressure is not forcing you to do bad deals, and you're able to take your time, look through the good deals, and provide the adequate return that you guys promise to your investors. Is there a specific return metric that the investors expect when investing with you guys?
I don't know if there's a specific return metric. Look, our credit fund, we lend at 13%. We pass a lot of that on to our investors. They're seeing a number that's not different. That's not that different than that number. And on the equity side, we've historically done really well. We've, our IRRs and returns since the early 2000s are good numbers that, are well into the double digits and things we're proud of. So, look, we don't say, hey, this is what every single deal is going to be like, but we can point to a track record, which is, done a nice job, and that gives our investors confidence. And look, that makes it really easy and quick for us to raise money when we need it to. And that's why we don't have the pressure to allocate it out, because we know, hey, when we need it, we can just go get it. And therefore, it's not like, hey, we need to spend 2 years raising this fund that's going to do this and that. It's like, when the opportunity is right, we'll raise money to acquire properties. And that investment, that raise will move really fast. And it gives us, the opportunity not to put pressure on our investors or ourselves to do deals.
Yeah, absolutely. That absolutely makes sense. In terms of, based on what you're saying, it's pretty much the opportunities is the only limiting factor for your growth. Is finding the actual good deal to invest into.
Yeah, absolutely, you're spot on. I would say we have an issue finding deals, not an issue finding equity. If we could have as many deals as we if we had as many deals as we could fill all the equity, we'd be really, really happy. That's never been a problem JDI's had. I've only been here for a year, but from what I understand, it's never been an issue for us historically. I think we'd love to have that as an issue, but it just hasn't been in the past.
Yeah, God willing, with the rates going down, it'll be a little bit easier to underwrite more deals. One underwrite, even though everybody thought 2025 would be the year that rates go down, and it looks like now it's gonna be 2026. So there may be more distressed properties out there, more deal flow happening in 2026.
Yeah, it's what it seems. And look, this is a good example too. Like interest rates, it's not something we like to bet on. We're only going to do a deal if it makes sense with interest rates at fixed rate debt for a long time, where the interest rates are today. So JDI does not do any floating rate debt. I would say over, in 2021 and early 22, before interest rates started rising, we refinanced most of our portfolio to fixed rate debt. And if we paid a 50 basis point or 100 basis point premium for that fixed over floating, we were fine with that. And then 2 years later, we're really happy with that, right? So, our deals need to make sense with fixed rate debt in today's market. Otherwise, the deal doesn't make sense for us.
So even now that there's a concern for you guys that the rates may go up on the floating debt?
We don't have floating debt. So again, if we're going to underwrite a deal and I'm going to go get debt on it today, it'll have to be fixed rate or some sort of swap, type of, product out there for that. So we don't have the risk on the rising debt. On the rising interest rates if they go up. So, So yeah, we're looking at stuff today at fixed rate in the 6s, maybe into the low 7s, and deals need a pencil with that. And we don't want negative leverage, so that's hard. So I'll tell you, we're not doing a whole lot of multifamily today, right? It's hard to do multifamily for us in today's market because we want positive leverage and we don't want floating rate debt, and that's doesn't that makes it so we're not doing a whole lot of multi deals, but that could always change, like you said, right? Who knows what's going to happen for the next 6 to 12 months.
Yeah, a lot of developers that we work with before, they were so very concerned about floating rate debt, but now they're kind of dialing it back. They're more comfortable getting it, especially if they get a better rate, just kind of knowing that the rates are extremely unlikely to increase at this point. Nobody really sees a situation where the Fed comes back and increases rates. It's obviously a possibility, but a very small one. So that people are becoming a little more lenient.
Yeah, we're starting to see lenders actually issue term sheets with floors. This is the floor. A year ago, you would never see a term sheet with a floor. They weren't worried about the floor, right? A year and a half ago. But now the floors, and then even some floating rate lenders, what we started to see is at closing, even though it's floating, so it can float up, but it can't float down. So it's fixed at a certain rate. So it's interesting how the market is changing year over year. But you never say never, Farrukh. So the rates can go up, but the way Powell speaks, sometimes you may be surprised.
I mean, never in 1,000 years that I think the rates would stay this high for 3 years. It's just not normal. But nobody could have anticipated it, and I think a lot of developers did get in trouble. And I wouldn't even say because they were aggressive. It's just logically speaking, it didn't make sense for the rates to stay so high, so long. But yeah, hopefully, I've been saying this for the last 3 years. Hopefully, in a few months, the rates go down. At this point, I don't even believe there's hope anymore. But everybody's kind of hoping. But I think the way you guys are doing, you guys are very safe. You underwrite, you look at deals going in at a decently high cap rate. You want an exit cap of 10. That's very high. So I know the deals that you're looking at are just cash flow strong from the beginning. But Adam, overall, thank you so much for coming on the show. We had a very pleasant conversation. Thank you for bringing a lot of insight into the senior housing space. I'm sure a lot of our viewers would love to hear it. A lot of our developers that work with them, mostly multifamily, retail, industrial. So senior housing is a bit different. Thank you for providing this insight.
Yeah, thank you both for having me on. This was great. This was fun. I really enjoyed meeting you both, talking to you guys a little bit. Thanks for the thoughtful questions. And let's do it again. We'll always be happy to come on.
Absolutely. Thank you very much, Adam.
Thanks.
Thank you.